Imagine a city, right? And they spend, I don't know, billions of dollars building this pristine, state-of-the-art, high-speed rail network.
Okay.
And it's specifically designed for like global freight, heavy industry, really serious commerce.
Right.
But on the very first day it opens, a group of local teenagers just kind of sneaks in, completely ignores all the freight cars, and they use the tracks to build a massive, unauthorized, just looping roller coaster.
Yeah, and the wildest part of that analogy is that the teenagers' roller coaster immediately starts generating more revenue than the freight trains ever could.
Exactly. I mean, it's insane. And that is literally what happened this past July on the Robinhood Chain. So we're doing a deep dive today. We're looking at a massive stack of sources.
Yeah, quite a stack.
We've got on-chain data, market analysis from CoinEx, ChangeNW, Crypto.news, Atomic Wallet, MarketBeat. And we're trying to unpack how this, very serious financial infrastructure play got completely hijacked by an unregulated meme coin called CASHCAT.
Yeah, hijacked is the right word for it.
And we're also zeroing in on a massive structural event that's coming up. Because our core focus today is the CASHCAT Crypto price prediction, September 2026.
Right.
Because to understand where this token goes next, you have to understand the completely bizarre foundation it's built on.
Yeah, you really do. And I think to appreciate the scale of this, we first have to look at what Robinhood actually built. Yeah. Right. So they launched an Ethereum Layer-2 network back in July.
Right.
And, to put that in plain English, the main Ethereum blockchain it's like a major highway during rush hour.
Right. Super congested.
Exactly. It's congested, and the tolls, the transaction fees are just incredibly high. So Robinhood used technology from a company called Arbitrum to build what is essentially an express carpool lane.
Okay.
So this layer 2, it batches thousands of transactions together off the main highway, processes them in like a fraction of a second, and then just sends a single cheap receipt back to Ethereum.
So the whole goal was high speed and practically zero cost. Yep. And, according to their own corporate roadmap, like if you read their stuff, this was explicitly designed for real world assets, like RWA.
Yeah, serious stuff.
Right. They wanted tokenized equities. They wanted institutional finance, basically a bridge between Wall Street and the blockchain. But the asset that's actually driving billions of dollars in volume on this network is a cartoon cat holding a fistful of cash.
Yeah, a cat that is actually based on an abandoned internal code name.
Right.
And it was a mascot that Robinhood's founders discarded like over a decade ago.
It's so funny.
It is. And it creates this really fascinating tension because you have a highly regulated, publicly traded brokerage, and their new flagship network is basically being sustained by a fan fiction meme coin that was just created by anonymous developers.
It's a literal billion-dollar inside joke.
It really is.
But, jokes don't usually hit a $200 million market cap by accident.
No, they do not.
When we look at the internal tokenomics of CASHCAT from the Atomic Wallet and CoinEx reports, the developers, they clearly knew how to engineer a viral financial asset. They basically removed all the standard friction points that usually scare retail traders away.
Yeah, they engineered it for maximum trust in what is honestly an inherently untrustworthy space.
Yeah.
First off, the total supply is fixed. It's exactly 1 billion tokens.
Yeah.
There is no minting function in the code. So that means nobody can ever print more and dilute the value.
Which is huge.
Yeah, and there's no venture capital backing looking to, dump their bags on retail buyers.
Yeah.
0 tokens were allocated to the team. And furthermore, they set the buy and sell tax to 0%.
Which I just want to highlight that because a lot of these tokens have these really sketchy hidden smart contract clauses.
Oh yeah, honeypots.
Right, where they slice off like 5 or 10% every single time you try to sell. It basically traps your money.
Exactly.
But the biggest green flag for traders, at least according to the sources, seems to be the liquidity pool.
Yeah, the locked liquidity pool. That is the anchor of this entire operation.
Right.
So for a token to actually be tradable, there has to be a giant pool of assets.
Right.
Usually it's the meme coin paired with a stable asset like Ethereum, and it's sitting in a smart contract. That pool is what allows you to buy and sell instantly without having to wait for another human on the other side of the trade.
Right. So you're trading against the pool, not a person.
Exactly. And by permanently locking that pool, the creators completely eliminated the risk of a classic rug pull.
where the developer just, drains the underlying funds and vanishes into the night.
Exactly. You can't steal what's mathematically locked away.
Right. Plus, there's a deflationary mechanism baked in, right?
Yeah, this is key.
Because a portion of the swap fees collected from people trading in and out of that pool, it's automatically used to buy CASHCAT and burn it.
Yes.
Meaning those tokens are just sent to a dead digital wallet and they are permanently deleted from existence.
And we should probably explain the physical effect of a burn on the market.
Yeah.
Because the total supply of tokens is constantly shrinking, right? If the market demand stays exactly the same, the mathematical scarcity just artificially drives up the price of each remaining token.
Wow. Okay.
So you pair a culturally resonant story, the ghost of Robinhood's past, with infrastructure that signals extreme safety to traders, and a mechanism that is constantly eating its own supply.
It's basically a powder keg. And the market response was just staggering. I mean, CASHCAT launched on July 1st at basically, I don't even know how to say it, a fraction of a penny.
Yes, 0.0000 something.
Yeah, and within 9 days, it exploded over 18,000%. It hit an all-time high near 23 cents by mid-July.
Unbelievable.
And the sources, they point to these wild stories, like traders turning $85 into nearly $687,000 in realized profit.
Oh my God.
With more, by the way, more still just sitting on paper. But it wasn't just the clean tokenomics driving this, right? Like external catalysts played a massive role, specifically Robinhood CEO Vlad Tenev.
Yeah, that was a huge moment. He posted on X basically acknowledging the insane volume on the network.
Right.
And he validated that the new chain could handle meme coin activity right alongside their serious real-world assets.
Okay.
And that tweet, it was treated as a tacit endorsement by the entire community. And following that, on August 6th, the token actually got integrated into a retail trading app.
And that integration is critical because it meant people no longer had to navigate, those really complicated self-custodial crypto wallets to buy it.
Yeah, the barrier to entry just dropped to zero.
Right. It opened the floodgates to everyday retail users. And I want to push back on this a little bit.
Okay.
Because I'm looking at the on-chain data provided by Bubble Maps in our source stack, and I have to challenge the idea that this was purely organic retail enthusiasm.
Interesting, okay.
Because Bubble Maps flagged this massive cluster of freshly created wallets, right? And they were buying up $2.7 million worth of CASHCAT right before that retail listing was announced to the public.
Yeah, I saw that.
Yeah.
And blockchain analytics are incredibly revealing here because, the ledger is entirely public. Everyone can see everything.
Right.
So a cluster mapping tool, it looks at the origin of funds. And in this case, the analytic firms can see a central digital wallet distributing Ethereum into 50 brand new, completely empty wallets.
Just funding them all at once.
Yeah. And then all 50 of those satellite wallets turn around and they buy millions of dollars of CASHCAT at almost the exact same second. And this is days before a major catalyst.
I mean, that looks exactly like someone with insider knowledge loading up on a sure thing, but, trying to hide their tracks.
It does. It looks highly suspicious, and it absolutely fits the profile of insider trading. But the nuance that the sources bring up is that in decentralized finance, sophisticated arbitrage lots, and high-frequency trading firms, they also use this exact strategy of rotating fresh wallets.
Oh, really?
Why? They do it to obscure their trading algorithms from competitors who might, try to copy their trades.
Oh, I see.
So the data presents an ambiguous picture. It doesn't definitively prove malicious intent on its own.
Okay.
But it certainly injects a layer of structural risk that investors have to price in.
Well, speaking of structural risk, even if we assume the internal economics are clean and there's no insider trading, the actual infrastructure supporting this token on the Robinhood chain proved to be incredibly fragile.
Oh yeah, the NOXA situation.
Right. We have to look at what happened with NOXA.
That outage fundamentally changes how we need to think about risk in these markets.
Okay, so NOXA, it was a hybrid launchpad platform, right? And in the early days of the Robinhood chain, roughly 75% of all new tokens were deployed through NOXA.
Right, it was a monopoly, basically.
And it was pulling in over $2 million in protocol fees in a single day, like briefly out-earning some of the biggest platforms in crypto.
Yeah.
And then the website simply went dark for 2 days just because of a cloud hosting failure. Like a Cloudflare issue.
Which is wild. And this incident, it introduced the market to the difference between custodial risk and attentional risk.
Okay, wait. Let me try an analogy to visualize this, because this confused me at first.
Go for it.
So we established that the liquidity for CASHCAT is permanently locked on the blockchain, right?
Yes.
The developers can't steal the money, so it's like having a giant vault full of gold.
Okay.
But if the NOXA website goes down, it's like someone turned off the lights in the vault room, locked the doors, and just walked away. You still mathematically own the gold, but nobody can see it and nobody can easily treat it, so panic just sets in.
That captures the mechanics perfectly, because in traditional finance, we worry about custodial risk, right?
Yeah.
Like, is the bank going to lose my deposits?
Right.
On the blockchain, the smart contracts protect the custody of the assets. And a smart contract is just a piece of self-executing code living on the network.
Okay.
So when NOXA's front-end website crashed, the back-end smart contracts were perfectly fine. If a trader knew how to write command line code and talk directly to the blockchain, they could still buy and sell CASHCAT.
But retail traders don't know how to code command line transactions.
Exactly.
They rely on the website interface, like the buttons and the charts.
Which is the core issue. A meme coin doesn't need its liquidity stolen to collapse. It just needs the machine that manufactures its urgency to disappear.
The attention machine.
Right. The trending feeds, the progress bars, the visual interface. When the website breaks, you suffer an attentional rug pull. The tokens are safe, but the demand just vanishes.
An attentional rug. That's just a brutal vulnerability.
It is.
But the community didn't just accept it, though, right? Because the sources show they quickly rallied to build an alternative platform called Let's Cash.Fun to replace NOXA.
Yeah. And the engineering behind Let's Cash Fun really highlights the resilience of these decentralized communities. Yeah. They built this new platform on top of Uniswap v4.
Oh, okay.
And what makes v4 unique is that it allows developers to write custom code, they call them hooks, that execute automatically at the exact moment a trade happens.
Like an automated toll booth.
Yes, exactly. A toll booth that automatically splits the revenue. So the community programmed these hooks so that 70% of the launch fees go directly to the person who created the token.
Okay.
And the remaining 30% goes to a protocol treasury. And that treasury is then programmed to automatically buy back native CASHCAT tokens and burn them.
Oh, wow.
Yeah. So they basically weaponize the volume of the entire launchpad to create constant automated buying pressure for their own mascot.
I mean, that's brilliant engineering.
It really is.
But here it doesn't solve the broader environmental problem, because it's like someone opened a high-end casino but completely forgot to hire security. So now there are, card counters and pickpockets at every single table. The Robinhood Chain has just been flooded with bad actors trying to exploit this 18,000% surge.
Well, opportunists always flock to volume, right?
Yeah.
And the most prevalent threat, detailed in the reports we looked at, is the proliferation of lookalike tokens.
Yeah, this was crazy to read about, because if you track prices on CoinMarketCap versus CoinGecko, you end up looking at completely different assets that share the exact same name.
Yeah, the ticker is identical.
Right, and the real CASHCAT lives on a specific domain, cashcat.cc, and it has 100% of its token supply circulating in the public market.
Right.
But scammers have launched identical tokens on variations like cashcat.store.
Yeah. And the danger of those lookalikes lies in their hidden smart contracts. Because the fake tokens, they hold back massive amounts of the supply. Sometimes it's like 50% reserved for fake liquidity and another 10% kept by the team. So they basically wait for retail buyers to artificially pump up the price. And then the creators just dump their hidden supply all at once. It drains the real value out of the pool and leaves the buyers with completely worthless digital paper.
It's just a classic scam. And the attacks aren't just isolated to fake tokens either, because the Crypto.news source mentioned that the official @CashCat Hoken account on X was suspected of being hacked right as the price was hitting its peak.
Oh yeah, that was a mess.
The attackers pinned a phishing link right to the top of the feed, and it promised, holder rewards, but it was actually a malicious contract designed to just drain the wallets of anyone who connected to it.
And these systemic traps, they lead directly to probably the most sobering data point in the entire on-chain analysis.
Yeah.
Which is that despite the highly publicized stories of traders making millions off a tiny investment, 53% of the people trading meme coins on the Robinhood Chain are currently sitting on net losses.
63%. I mean, it makes sense when you think about it. The money doesn't just materialize out of thin air.
No, it doesn't.
For every single wallet that realizes a massive, 1000x return, there has to be a long tail of everyday retail buyers providing the exit liquidity by purchasing at the top.
Exactly. The velocity of these speculative markets dictates that the majority of late arrivals will just fund the profits of the early adopters. It's a zero-sum game in that sense.
Right. But, all of these hacks, the lookalike scams, the attentional rugs, they only really matter if people keep showing up to the casino to trade.
Very true.
And that points us to a massive structural threat that could honestly kill the volume on this network overnight. Which brings us to the core focus of this deep dive.
Yes, the big one.
The CASHCAT Crypto price prediction, September 2026. Because everything we've talked about is leading up to this moment.
Right, because the entire future valuation of CASHCAT hinges on an upcoming event that the analysts are calling the gas cliff.
The gas cliff. So I was looking at the timeline of the July 1st launch, and Robinhood implemented a 90-day promotional window where they heavily subsidized all the transaction fees on the network.
Right.
And in the crypto world, these are called gas fees, right? It's the cost you pay to the network to process your trade. So for the first 3 months, trading on Robinhood Chain has been essentially free.
Free trading, right. And the market right now is desperately trying to price in what happens when that 90-day window expires in late September, because a staggering amount of that billion-dollar trading volume we've been discussing, it was likely generated by high-frequency arbitrage bots and retail traders just executing hundreds of microtransactions a day.
Right, because there was zero friction. You could trade $10 back and forth 50 times and it wouldn't cost you anything.
Exactly. But once that promotional period ends, the math changes entirely. If a bot is suddenly paying, $2 or $3 per swap instead of zero, making thousands of micro trades burns a massive hole in their operating budget.
So they just turn the bots off.
Right. The velocity of the network could plummet instantly. The gas cliff is basically the ultimate stress test. It will reveal whether CASHCAT has genuine staying power and real cultural stickiness, or if its multi-million-dollar valuation was just a mirage built on artificial zero-fee network conditions.
Okay, so let's look at the current state. We're sitting in late August right now. CASHCAT is trading around 0.197, so it's maintaining that roughly $200 million market cap.
Yeah.
But it is suffering a 10 to 15% pullback right now. And I'm trying to figure out, based on the reports, if that's early panic about the gas cliff or if it's something else entirely.
Well, according to the market analysis, the current pullback is largely driven by macro sector rotation rather than internal network panic.
Okay.
So capital is moving out of speculative high beta assets. And high beta simply means an asset is far more volatile and it moves much faster than the broader market.
Right.
So investors are basically taking profits from those really risky bets and they're rotating their money back into the relative safety of Bitcoin.
Right, the flight to safety. And the short-term forecast for that rotation, it hinges heavily on the upcoming US PCE inflation data report.
Exactly. The Personal Consumption Expenditures Index.
Right.
It's the Federal Reserve's preferred gauge for inflation. So if that data comes in hotter than expected, meaning inflation is stubbornly high, it tends to strengthen the US dollar and trigger a massive risk-off environment across all financial markets.
Okay.
And in the crypto sector, risk aversion usually means selling altcoins to buy Bitcoin or just moving straight to cash.
So if that macro gravity pushes Bitcoin down below its current support level, which is what, around $78,000 right now?
Yeah, right around 78K.
If it drops below that, it's going to drag the entire altcoin market with it.
Oh, absolutely.
And the technical analysis in our sources suggests that a Bitcoin drop would drag CASHCAT down to test its 15-cent support level.
Yeah, the 15-cent level.
And they mentioned, this is interesting, they mentioned this lines up with the 38.2% Fibonacci retracement. Which, just to translate the technical jargon for a second, that just a mathematical ratio, it's derived from nature, that traders use to identify psychological price floors. So when an asset drops 38.2%, it's just a very common level where buyers step back in thinking they're getting a good deal.
Right. It's a psychological support zone. But conversely, if the inflation data is cool and Bitcoin holds above that $78,000 mark, the reports show CASHCAT actually has the technical strength to consolidate near its current 19-cent level.
Okay.
And potentially even attempt to break its all-time high of around 22 cents in the short term.
I mean, I hear that, but I'm having trouble seeing how this sustains itself long-term, though. Like, if the free trading stops in September, doesn't the token just slowly bleed out as all the tourists pack up and leave?
Well, that perspective actually aligns perfectly with what the sources outline as the base scenario for late 2026.
Okay.
So this scenario projects a severe contraction. It places the price range between 6 cents and 18 cents. The gas cliff hits, the transaction costs return, and the novelty of the Robinhood chain just kind of burns off. Right.
So without that zero-fee environment, the speculative hype just fades away.
So it survives, but it becomes like a zombie token.
Kind of, yeah.
It would just trade sideways, maybe occasionally spiking if Robinhood makes a corporate announcement about the broader network, but losing all its organic momentum.
Exactly. It would settle into a mid-tier range, and it just act merely as a proxy for the chain's general health, rather than being this breakout star.
But there is an optimistic scenario outlined here, too.
There is.
And it projects a massive run up to between 20 cents and 55 cents. But like reading through the requirements in the Change in W report, it needs an incredible confluence of events.
Oh yeah, it's a tall order.
Robinhood Chain would have to successfully prove it can retain its retail users even after introducing gas fees.
Which is hard.
Very hard. Plus, CASHCAT would need to secure major listings on centralized exchanges to tap into fresh pools of global liquidity. Right. But if those catalysts occur, CASHCAT transcends being just a meme coin. It basically cements itself as the undisputed blue chip mascot of the entire Robinhood Chain ecosystem. And we've seen this exact playbook before, on the Solana network with a token called BONK.
Right. BONK became the cultural index for Solana.
Exactly.
Like if you believed in the network, you held the dog token.
Yeah.
And CASHCAT is attempting to do the exact same thing, just with a corporate cat. It is wild to think about because the entire future of this asset, whether it crashes to 6 cents or skyrockets to 55 cents, is entirely derivative of the corporate strategy of Robinhood.
Right.
Even though Robinhood officially has absolutely nothing to do with the token.
It's the ultimate irony of narrative investing.
Yeah.
I mean, you have an asset with zero functional utility that has generated hundreds of millions in value simply by weaponizing a corporate brand's history. It has survived cloud hosting blackouts, attentional rugs, malicious hacks, and now it faces its final boss, the end of subsidized trading.
We basically watch a discarded sketch of a cat turn into a financial juggernaut.
We really have.
But as we wrap this up, there is a broader philosophical paradox hidden in this data that I can't stop thinking about.
Oh, yeah. What's that?
It centers on the regulatory reality that Robinhood faces right now.
Oh, right.
Because think about the position they're in. They are a highly regulated, publicly traded entity.
Very regulated.
They spent immense capital building this chain specifically to be an institutional-grade network for tokenizing real-world assets. They want strict compliance. They want Wall Street integration.
Yeah.
Yet the single biggest success on their chain, the entity driving all the volume, stress-testing the infrastructure, and grabbing all the headlines, is an unregulated, community-hijacked meme coin named after their own discarded mascot.
It creates an incredibly delicate tension between, corporate compliance and organic user adoption.
Yeah.
Because on one hand, they want the volume. On the other hand, the SEC is watching.
Exactly. And here is the thought to leave with today. As regulatory scrutiny inevitably hits this new network, because the SEC and global regulators are watching billions in volume flow through this thing.
Oh, absolutely.
What happens? Will Robinhood be forced to crack down on the very token that put their high-speed rail on the map? Or will they have to quietly, unofficially embrace the teenagers running the roller coaster because right now, they are the only ones paying the bills?
It's a great question.
It's going to be a very telling September.